I find that you can watch tons of options videos and they are going to overcomplicate things. So as a trader, in this video, I'm going to basically give you things I look out for and then some optional things that you could also look out for just before entering a contract. So let's head over to the computer and I'm going to give this to you guys all for free. All I'm going to ask you to do is like the video, subscribe to the channel, and turn post notifications on. Let's get into the video. First things first, I personally use Mumu. No, this isn't a sponsor. Reason I do it is because they show you tons and tons of option strikes basically down the line so that you don't have to change the single option strike price to see what's going on. And it also just shows right next to it the implied volatility, open interest, volume, premium, all this other stuff, right? So right off the bat, I use Mumu. Even if it's not to trade them, I use it to basically view the options chain before I enter on Webull or a different broker along the lines of that. So the first thing that I'm going to look for as soon as I open my Mumu app, let's say that I eye up a trade. Okay, this is one of the first things that I'm going to look for, put very simply, before you enter an options contract: volume as well as open interest. Volume and open interest indicate liquidity. So the more liquidity in the contract, one is going to give you tighter spreads and easier exits, but it also just indicates confidence in this contract. It indicates that this contract is being traded a lot, possibly by big money, which is an optional thing you can look for: unusual buys or unusual sells or things along the lines of that in the contracts. So first things first, you think of a trade that you want to do, you open up the Mumu app or you open up an app and you go and you look at volume as well as open interest. You want high volume, you want relatively high, or you want high open interest, you want relatively high volume correlated to your open interest. I'll give you more of an example later in the video. I'll give you an example of a contract that I would enter if I saw XX on a chart, right? So this is the first thing you want to look into: high open interest. Put very simply, before you enter your contract, make sure it has high open interest. Well, lottery stocks, my broker doesn't show that. Use my link and open a Mumu account just to at least look at them. Next, implied volatility. These two are non-negotiable. There's some that I'm going to give you that are negotiable, and then some that go in tandem, and then some that kick the other Greeks out of the water. Which this isn't one of the Greeks for the options, but you want to look at the IV, implied volatility. Put very simply, if IV is too high, I wouldn't even touch the contract. Too high, depending on the play, it could be a short squeeze, it could be a major catalyst or event happening, earnings, right? And IV could be 150% to 450%, right? Those implied volatilities are too high. That means you are paying an insanely high premium to even get into the contract. You want to look for low IV or lower IV. So what I would say is, hey, it's picking up some eyes, including yourself. Maybe the IV is around 70%. That's okay. You can enter that. Maybe it's even around 90%, but you have some good expiration. You can enter that as well. These are just some things that I look out for, and I'm going to try and keep this very simple, and I'll give you a simpler breakdown later in the video. Other things you can look at, this is where it becomes somewhat optional. Delta. Delta is something to look at for the Greeks when you go and you scan the option chain before you enter. Higher delta is basically the price movement per $1 stock move. Now, to simplify things, it measures the price sensitivity and probability to in the money. So a 0.5 delta at the money, closest to current price. 0.3 or 0.4 delta, slightly out of money, popular for directional plays. So if you're looking for, we'll say GameStop per se to hit $30 to $35 in a month and it's at 28 bucks, right? Delta's probably going to be around this range, slightly out of the money. 0.1, 0.2 delta for lotto style trades or deep out of the money speculation. So that $120 strike or something on GameStop, way out of the money, you're going to have a lower delta, which means you're going to have lower price movement on the contract per $1 stock move. And again, this is going to change when you get closer to the strike price. Reason being are the Greeks that we're about to talk about. But you want to look at delta, you want to look for high delta. And this is going to change. But initially, look for high delta, especially depending on the play that you plan on doing, which we'll talk about. Gamma is the rate of change of delta as the stock moves. Now, hang in here with me, because this is where a lot of the videos get complicated, and I'm not going to overcomplicate them for you. Rate of change of delta as stock moves. So a higher gamma equals delta increases fast as price move. This means big gains if stock surges, and it's important for short dated out of the money options near big levels. So what you want to look out for is gamma spikes near at the money options with low DTE, which is great for lotto plays and breakout squeeze setups. So if delta is 0.3 like we talked about and gamma is 0.1, a $1 stock move, delta jumps to 0.4. Again, this is gonna be complicated in your head, but what you want to do is simplify it, and these are more of the optionality things to look at. Okay, all three of these are going to go hand in hand, theta as well, but theta is a little bit more important on its own, but also is going to tie hand in hand with these. This is obviously how much value you lose daily just for holding. You've probably heard of theta in every single options video that you have ever watched. And it's not only about how much value you're gonna lose on a daily basis with the theta, it's also just how far expiration. I mean, make it simple. How far expiration are you gonna look at? If I were to open my phone right now, and I'll give you the example pretty soon, right? But if I were to open my phone right now and I thought something was gonna be at a different price in 3 days, I'm still gonna grab 2 weeks out. It's simple. This way you don't have to stare at theta and see how much you're going to lose on a daily basis. You just grab extra time, okay? This is where these three tie in together. Gamma linked with high delta, high gamma linked with high delta equals delta changing faster, or explosive gains or explosive losses. This is why it's important for your contract. So if you're looking at high gamma linked with delta, the delta is going to change faster. So as the price moves, you're going to have a lot of gains or a lot of losses. Now, if you link high gamma with theta, time decay increases too, which means it's riskier to hold. So if you see something with high gamma and then also high theta, which the gamma is going to affect the delta, and again, stay with me, the reason being delta linked with theta increases the theta. But again, gamma linked with delta increases gains or decreases or increases losses as well. So it amplifies things. So each and every one of these hand in hand with each other is going to amplify or amplify, yes, in both directions, your gains or your losses. So time decay increases too, which means it's riskier to hold when you have a high gamma linked with high theta, so on and so on. Now, here's what you want to look for. If you want to look for the optionality things alongside high open interest as well as implied volatility, the premium you're going to pay, you want to look for a high delta, 0.3 to 0.5, which is more responsive to stock movement, higher profit per dollar move. And you want to look for higher gamma, which is close to expiration, at the money or out of the money, meaning delta is going to increase fast, option is going to explode in value of stock moves. These are all short-term plays. Low IV, below 30% IV percentile. This is just the base thing. It means options are cheap and there's less premium baked in. The likelihood of you finding these are kind of low unless you're trading SPY or something along the lines of that. Low theta, further from expiration, at the money, slow time decay. Slow time decay gives you breathing room. This is a kind of a non-negotiable. Low theta, no matter what, and it's not only about looking at the calculation on the Greek, it's about just buying extra time every time you get into a contract. High open interest or volume, obviously better liquidity, tighter spreads, easier to exit. What is tighter spreads? What is that? Because I didn't really talk about that. Better liquidity, tighter spreads, easier to exit. When you jump in a contract, do you ever notice that you jump in and you're immediately down $50 or you're immediately down $200? These are things that you don't look at or don't pay attention to, and how it can affect it, right? Some of these high open interest or high volume plays are going to give you tighter spreads, meaning you're not going to lose. Maybe you'll lose $2 when you enter instead of 50, right? Since the spread is tighter. Okay. Now, all of these things are good and all, but in reality, you're not going to have them. You're not going to have all five. In a perfect scenario, you're probably going to trade off one or two, maybe even three, depending on how confident you are in something. So here's some examples. If you're looking for big move potential or a lotto play out of the money, you're gonna likely sacrifice higher gamma, but lower delta and higher theta. Okay, this is why you don't look at all of these, but no matter what, you look at open interest, implied volatility, and getting for further enough expiration. If you're looking for cheaper premiums, so lower IV, you might get lower delta or less liquidity. And if you're looking for safer long-term plays, you are probably, cheaper premiums, you're probably going to sacrifice lower delta, lower liquidity. Of course, safer longer-term plays, you're probably going to sacrifice lower gamma, but lower theta too. Okay. Example, fast move lotto play. You're ready. You're going to see high gamma. You're going to look for high gamma, high delta, high open interest, possibly low IV. Theta will be high because this is going to decay your contract fast. You're getting a fast move lotto play, but you're playing the momentum. Safer swing trade, which is the most that I probably play. Delta at a 0.5, low theta, low IV, high open interest. These are the contracts you want to look out for. At least the ones I look out for. Gamma won't be huge, but delta gives solid price movement. So either way, you're still going to make a decent amount of money. IV crush setup post earnings. You're looking for low IV, low theta, high delta, safer entry after implied volatility collapses, and ideal for trend continuation. Now, let me tell you a good example, and I'll find one right now. SPY is trading at 594.33. Let's hypothetically say, let me grab this. Open up Mumu real quick so I can look at the options. Let's assume, well, first of all, right, just a cool thing you can look at. You can look at total open interest on the plays, right, in the options market over on Mumu. You can also look at open interest increases. So we can see that recently, SPY August 15th, puts have been being purchased, 465 puts, which is actually a weird buy right here. Open interest decreases. There's a decrease in the calls all along here, SPY. So SPY is showing some bearish divergence here. You can see all this stuff. But so what we're going to do, look at SPY, and let's say I assume in the next 3 days, SPY is going to be down to, we'll say 585. Okay. I think SPY is going to crash down here to 585 over the next 4 trading days, we'll say. So I'm on the options chain right now. Let me just start my screen recording here just to kind of pop up something for you guys. So I'm on SPY right here. I go to puts. Today is June 20th, expiration. I'm not even going to look at these. I'm going to scroll and probably grab July 18th to give myself a few weeks. Okay, July 18th, I'm looking for puts. Boom, right off the bat, I already see something enticing. I see 590 puts with open interest sitting almost at 50,000. You can see the ones around it are 8,000, 2,000, 2,000, 4,000, 5,000. I see one almost at 50,000. Then I see volume 7,500. The ones around it are 1,300, 400, 600, 1,900, 900, 590, 490, so on and so on and so on. This is already an enticing contract. Hey, $894. Maybe you can't afford this. Maybe you want something cheaper, right? Well, you go down the line. You're pretty confident in this trade. The next thing I see that looks decently enticing, 585s. It's cheaper. It's $758. It has 30,000 open interest, 3,900 volume. I mean, I'm looking at these immediately because it's non-negotiables. It's non-negotiables, okay? You go down the line and you find these discrepancies. Now, what you can also do is check the calls, right? Check the calls for the same expiration date and see if institutions, big players are bullish. Immediately, I see 17,000 calls for the 595s. That's a little iffy here, still kind of low, but the 600s look pretty good. 37,000 open interest, almost 10,000 volume. So we're seeing a lot of these things being traded today, but ultimately, put side of things still looks very, very strong. So my main contender, if I can afford it, is the 590 immediately off the bat. Implied volatility is also low. We're seeing some decent things as far as delta, gamma, and theta, but again, these are optionals. I already don't need the theta because I'm buying enough extra time. The gamma, the delta, they're going to affect each other. And if I'm confident and we're moving in the right direction, I'm still going to make a solid amount of money. Off the bat, that is something that I'm looking for, just opening up the app. It's a pretty easy example, and these are just things that I watch out for. And as a retail trader, when people try and overcomplicate the options videos for you guys, I find it extremely hard to understand and almost unfair. But this is a completely separate video. You want to find a technical setup that fits your play, and then you want to go based off of that, and then you want to go do what I did and check out the options chain. And I hope this helps you guys. If you're not in my Discord server, I have a Discord. It is the top link in the description of the video, where we talk stocks and crypto all day long. Best vibes, best people, best community. We have tons of benefits in there, AI alerts that actually give you options sweep alerts, insider trade alerts, dark pool trade alerts. So all of these things. And on top of that, we have high success trade flow setups. I'm in there on the daily. I chat with you guys. I also post my trades so you guys can come see those as well. And yeah, if you want Mumu, sign up and make a deposit right here. Third link in the description. I also have tons of other benefits in the description as well, like funded futures account, 50% off using code LOTTO at checkout, all that other stuff. But hopefully this helped you guys. And yeah, let me know your thoughts in the comments down below. Let me know if this is going to change the game for you. And hopefully it does. I'm here to help. Subscribe to the channel. I love you all. God bless. Lottery stocks out.